For years, you've been told, save your money. Put it in the bank for a rainy day. Build your savings account. It sounds responsible, right? But here's the shocking truth. In 2025, saving money the traditional way is making you poorer. Yes, you read that right. If you're leaving your money in a regular savings account, or worse, under your mattress, you're losing purchasing power every single day. In this video, we're going to break down why saving alone no longer works, the hidden reason your money is shrinking, what to do instead to grow wealth, a step-by-step strategy to make your money work for you, and how to escape the trap most people never see coming. By the end, you'll know how to protect your financial future and make your money grow, even in today's economy. Welcome to Smart Dollar Mindset, the channel where we teach you how to achieve financial freedom with smart money habits and investing strategies that actually work. Let's dive in. The illusion of safety and saving. We grew up believing saving is the ultimate financial habit. Open a savings account, deposit money regularly, and watch it grow. But here's the truth. In 2025, the average savings account pays 0.45% interest. Inflation is hovering around 4% to 5%, sometimes higher. That means for every $10,000 in your savings account, you're effectively losing $350 to $450 in purchasing power every year. You're not saving money, you're losing money slowly. Example. You save $10,000 in a bank account earning 0.45% interest. After 1 year, you earn $45. But if inflation is 4%, prices go up by $400. Your $10,000 now buys $9,600 worth of goods. That's the silent wealth killer, inflation. Why inflation destroys savings? Inflation means the value of money decreases over time. Prices rise, and your dollars buy less. Think about it. A loaf of bread in 1990 cost 75 cents. Today, it's over $3. College tuition? Don't even ask, it's skyrocketed by over 200% in 30 years. If your money is sitting idle, it's getting weaker every year. Why people still save, and why it's a problem. Comfort and security. Saving feels safe because your money is visible and guaranteed. Fear of risk. Investing feels scary because it's not guaranteed and markets fluctuate. Lack of financial education. Schools taught us to save, not how to grow wealth. But in today's economy, safety and saving is an illusion. The real purpose of saving. Don't get me wrong, saving isn't bad. It has a purpose. Emergency fund, short-term goals, vacation, down payment in 1 to 3 years. But beyond that, keeping large sums in savings is financial sabotage. So what should you do instead? What to do instead of just saving? The solution isn't to stop saving, it's to start investing strategically. Your money should do 2 things. Stay liquid for emergencies, grow for the future. Here's the blueprint. Step 1. Build an emergency fund before you invest. Create a safety net. Aim for 3 to 6 months of expenses. Keep it in a high-yield savings account, paying 4 to 5% in 2025. This covers emergencies without dipping into investments. Once that's in place, it's time to move beyond saving. Step 2. Understand risk versus reward. Money sitting in a bank has zero risk, but also almost zero reward. Investing has short-term risk, but massive long-term rewards. Example. $10,000 in a savings account for 20 years at 0.5% equals $11,045. $10,000 in an index fund for 20 years at 8% equals $46,610. That's the difference between barely moving forward and building wealth. Step 3. Start investing, even if it's small. The biggest mistake people make? Waiting until they have extra money to invest. Start small. Even $100 per month compounds into hundreds of thousands over decades. Options to start: 401k or 403b, employer-sponsored retirement plans, Roth IRA, tax-free withdrawals in retirement, index funds and ETFs, simple, low-cost, diversified investments. Why index funds are a game-changer? They track the market, which historically returns 7 to 10% annually. They're low cost, which means more money stays invested. They require zero guesswork, perfect for beginners. Step 4. Beat inflation with growth assets. If inflation averages 3 to 4%, you need investments that outpace it. Assets that historically beat inflation: stocks, long-term growth powerhouse, real estate, tangible, income-producing assets, bonds, in moderation. For stability in retirement, Rights, real estate exposure without owning property directly. Step 5. Automate everything. Automation is your secret weapon. Set up automatic transfers to your investment account every payday. Remove the temptation to skip investing. Build wealth without thinking about it. Why most people don't invest, and how to overcome it. Fear of losing money. Solution. Understand market cycles. Short-term volatility is normal, but the long-term trend is up. Belief that you need a lot to start. Solution. Start with what you have. Even $50 per month matters. Overcomplication. Solution. Stick to simple strategies like index funds and dollar cost averaging. The power of compounding. Here's the wealth building magic formula. Start early and invest consistently. Let compound interest work. Example. Invest $500 per month at 8% from age 25 to 65 equals $1.5 million. Wait until age 35? You'll end up with only $680,000. Time is the most powerful wealth building tool you have. Why just saving can cost you millions? Here's the reality. If you save $500 per month in a savings account at 0.5% for 30 years, you'll have $190,000. If you invest $500 per month at 8% for 30 years, you'll have $745,000. That's a $555,000 difference. Saving feels safe, but it's the most expensive mistake you can make over time. What about market crashes? The market will drop. It always does. But here's what history shows. Every crash has been followed by recovery and new highs. The people who lose money are those who panic and sell. The people who build wealth are those who stay invested. How to protect yourself from market risk. Invest for the long term. Minimum 10 years. Diversify. Don't put all your money in one stock. Keep an emergency fund so you don't sell investments in a panic, turning fear into freedom. The reason people cling to savings is fear. But fear fades with education and action. Once you understand that inflation is guaranteed, market volatility is temporary, compounding is unstoppable, you'll see that investing isn't risky, it's necessary. The 4-part money system you need in 2025: emergency fund, 3 to 6 months of expenses in high-yield savings retirement accounts, max out your 401k and IRA taxable investments, use brokerage accounts for extra investing, short-term goals, keep vacation money or down payments in savings, 1 to 3 years. This system gives you both security and growth. Examples of smart money moves: Emma saves $20,000 for emergencies and invests everything else in index funds. In 20 years, she's financially free. Jason hoards $100,000 in a savings account for 20 years. Inflation erodes its value to $60,000 in real terms. The difference isn't income. It's strategy. Why this matters more than ever: interest rates on savings accounts can't keep up with inflation. The cost of living is rising. Relying on savings alone guarantees a loss in real value. If you want financial freedom, you must move beyond saving and into wealth building. Final thoughts. Saving isn't bad, it's just not enough. The money you think is safe in the bank is actually shrinking. To win in today's economy, you need a 2-part strategy: save for emergencies, invest for everything else. Start today. Even small amounts matter. If this video gave you clarity, share it with someone who still believes saving alone is the answer. And subscribe to Smart Dollar Mindset for more tips on money, investing, and financial freedom. Remember, financial security doesn't come from saving. It comes from making your money work for you.